Ladies and gentlemen, welcome to the Google earnings review, call, listen along, all these sort of good things. We're also going to be looking over Microsoft, ServiceNow, Chipotle. What other ones do we have? Meta, Carvana, Starbucks, Transmedics, Coke, eBay, Teladoc. It is full earnings season right now. We are in the thick of it, ladies and gentlemen. So I'm going to also try something a little bit new this time where we also have the capability to potentially look at the stock price while we're actually listening to the call. I'm going to give that a try. We've had it done a couple times previously, but it's actually trickier than you think on this stupid freaking platform that I use. But unfortunately, there's not many other alternatives. All right. So as we get into earnings, let me pull up Google's share price. Carlos, thanks for becoming a member, my friend. Appreciate the support. We did also get a rate cut. We got a 25 basis point rate cut, and Jerome Powell is said to stop quantitative tightening on November 1st. Okay. Or sorry, is it December 1st? It might be December 1st. Yeah, December 1st. Now, we have a lot more to talk about that because he actually said that there's no foregone conclusion about if they are actually going to cut rates in December, and that they believe that the markets are getting a little ahead of themselves. Like, Jerome, you're the guys that said that you could see a potential rate cut every meeting until the end of the year. The reason why everyone has a 99% chance of a rate cut in October and December is because you said it. We didn't put words in your mouth, brother. That was you. It came out of your mouth. And now you're like, hold on, guys. We're going to be data driven here. And we're going to take our time. And it's definitely not a guarantee. Okay. Thank you. Anyway. Yeah, the reason for the rate cut around 235 was the meeting with Jerome Powell. That's whenever he said those words. So you can see the S&P exactly whenever that news was absorbed. So we took a massive hit, but it's because he said that there was no foregone conclusion if we were going to get a December rate cut. That's the reason. But Shift 4 is also down because of Fiserv. Fiserv's doing some sort of restructuring. I didn't actually get a time to read through it, but yeah, they're down like 40+%. It might actually, for me, not saying that this is something that you guys should copy, but for me, it might be a buying opportunity on Shift 4. I know the company very well. And, whenever one company is having problems, it doesn't necessarily mean that it is broad-based. Now, people are making some conclusions because it was because they had acquired a bunch of businesses. Shift 4 does a very similar thing. So that's why Shift 4 is taking a little bit of a hit on Fiserv news. Let me crack this drink open real quick. Sorry about that noise. Let's get back to markets really quickly as Meta, another company reporting earnings after the bell, is now showing that they are pushing into earnings. Love it, love it, love it. So we ended up seeing that Jerome Powell crash into recovery, right back into a positive day, up 0.4%, 754, as people look forward to Mark Zuckerberg and what he has to say about advertising, the metaverse, and of course, artificial intelligence in general. So Chipotle, let's make sure that we have all of these names ready to go. CMG, we got Now, we have Google, we have Meta, we have Microsoft. What else do you guys want to see? We have Mercado Libre. How did I miss that one? We got Melli, we got Carvana. We're going to try to cover all of this at 4 o'clock. So we got 11 minutes until the bell. Okay. Or 10 minutes and 15 seconds to be exact. And then we'll get through all of these names. We'll even look at TDoc and eBay as well. Now that's a juicy list. Okay. Wow, seeing big run-ups in some of these names. Meta's moving higher. Google's pushing higher. Google's really pushing high. I mean, up 2.5%, unfazed by what Jerome Powell had to say. And now actually at a company historic high going into earnings, 275.35, pushing new highs on Google just before earnings. This is incredible. Okay. Wow, we're still pushing. Are we going to get to 276 before? Okay. Our expectations going to be set a little too high going into earnings for Google. That's what we need to find out. Now, let me bring up expectations on Google. Wall Street is currently expecting EPS of $2.27 and revenue of $94.07 billion. I do not have my own expectations on this name. It's been way too busy for me to even review it, but expectations are actually lower than what we saw last quarter for revenue. Q3 usually does well. Not as good as Q4, but usually we see strength from Q2 to Q3. Usually that's up quarter over quarter. And expectations on Wall Street is actually that it goes down quarter over quarter. So we could definitely see a revenue beat just by trend. And then same thing for EPS. It's a usual beat quarter over quarter. Q2 to Q3, I'm seeing multiple years aside from 2022, and that holds true for revenue as well, that we usually see growth quarter over quarter, but yet Wall Street's actually expecting lower growth this time round. But we are pushing into all-time highs into this earnings. Anyone in Starbucks? I'll put Starbucks on the list as well. I'm definitely interested in seeing all of those names. As for other names that we are going to see today, we have Starbucks down 2%, eBay just flat, Teladoc down 1.2%, Carvana down 1.7%, Mercado Libre up 0.7%, Microsoft flat on the day, Meta flat, Google up 2.6%, ServiceNow down 2.5%, and finally Chipotle down 1%. Man, imagine if Jerome Powell is actually bullish, you know? I shouldn't say bullish. I should say dovish. In that, you know, he actually talked about cutting some rates. But no, he said the opposite. He cut rates by 25 basis points. And then saying, we don't know what's going to happen next. That's all right. That is all right. You guys want KLA on here as well, up 3%. They are also reporting earnings. Okay. By far, the biggest position that I have that's reporting earnings today is Google. I also am a shareholder of ServiceNow and Mercado Libre as well. So keep an eye out for those for names that are going to impact my emotions on this stream the most. Okay. Did I not put TMDX on that list? Transmedics is also on this list, up 3.5%. Okay, I think we have them all. My apologies. Yes, Transmedics is also today. BM&R, honestly, I have no clue. I've heard so much different things. I can't even find it on their earnings present or on their IR, their investor relations page. There's no sign that they're even reporting earnings. So I have no clue. I saw some companies report that it was today. I saw other companies report that it's on November 5th. I honestly don't know. Let's see what this website is showing it at. Yeah, they don't even have any earnings data on Earnings Hub. TradingView says it's today. Earnings Hub doesn't even say it exists. Who knows? And Google presses higher. Each and every cent that you guys see going up, this is a new all-time high. Like if I max out their chart, this is an all-time high for Google. Okay? In any point that you want to look at, this is a high for them. We're up in the last month 13.5%, 275.77. I was slamming the table to say buy on this company at around 140, 160, especially at 160, because we got great news from last earnings as well. And so we were able to grow positions and get quite bullish on Google over the last few quarters, all because people thought that they were going to die based on one competitor, ChatGPT. Well, that's not 100% true. Meta would put out things, Perplexity would put out things, and then people just thought it was complete death. Regulation, people thought that, Google Chrome was going to have to divest away from Google. That turned out to not be true, and they actually litigated in their favor. And actually, they put in the note that they said that the reason why they did that as well is that ChatGPT showed that they do have strong competition. But yeah. If BM&R is doing earnings today, I mean, we can put it on the list, but I don't think it is. And I will see news after earnings. Earnings, by the way, 4 minutes, guys. 4 minutes. But let's see if Google can push above 275 before earnings. And yeah. Google advertisements are annoying. It should only be the starting advertisement. I don't think I have any mid-roll ads or anything. This is an ad-free zone. Once you get past the initial ad, there won't be anything that disrupts the listening of the earnings call. It should be fine. Okay? Let me just double check that for you. Yeah, ads are off. Okay. Or you can buy YouTube Premium. It honestly is the only subscription that I actually purchase. And if you're a Google shareholder, I mean, you're kind of pumping their stock a little bit. You're giving them a fundamental reason to continue to climb, and you're giving them more money. Which one of you guys, like, what Google services do you use? Or are you guys just using, Google Chrome? Because for me, I'm a Google Workspace user. I use it for my business. I have a lot of their Nest products and a lot of the Internet of Things products. I don't have a Google Pixel right now. I need a Google Pixel, though. It was the best, phone I've had. I recently switched to a Samsung, and I regret it. So I'm going to wait out that until the next version of the phone, but then I'm going to get the next one. And YouTube Premium, I'm a paying member for. Some of the income that I make is from Google, so I'm also pumping the stock a little bit too, just being on YouTube right now. But yeah, starting to sell off a little bit. I wouldn't say that. We're up 2.6%. I don't think you can be a sellout for the stocks that you own. They're not paying me directly. Well, I mean, aside from YouTube, but that's not like, you guys are already here. I don't need to advertise that. Chrome, YouTube Premium, and Gemini. Yeah, I'm a Gemini user as well. I cannot wait to see the KPIs that they show for Gemini. I think a lot of the call, probably the majority, like I would guess like the percentage of the call, over 60% of it is going to be based on Gemini. Mail, calendar, YouTube Premium, the most. Yeah. Is Gemini better than ChatGPT? Honestly, I use all of them. I love ChatGPT. I love Gemini. And Grok, which is the one that I pay the most for, sucks. And it's honestly the worst. Fred Smith says, can I have a shout out? Sure, Fred. There you go, brother. Ooh, sorry. I thought you said Chromebook. I was like, no one ever talks about getting a Chromebook. Even JPow's pumping Google after pumping a lot of the data center names, saying how they're not affected by interest rates because they have such amazing business models and that they are not worried about a 25 basis point cut. It's quite a good thing to hear if you're into those types of names. So as a fan of NVIDIA, as a fan of Google, company building a lot of data centers, has a massive cloud business, cannot wait to see GCP We pray for good results. And I'm not saying that for just Google and not for Microsoft and all these other names. I want them all to win. Ladies and gentlemen, we are getting into the close. Google is now officially closed 275.17, very close to an all-time high, which they also hit today. Running into earnings, Meta running into earnings, or into the close. Let's see what we end up finding, not just for Google and Meta and Microsoft and all these names, but for Chipotle, eBay, Starbucks. We're going to try to find it all for you guys in this stream. Okay, and now we await. Let's see if Bloomberg Terminal usually gets to the information first. So we usually see a spike in the stocks before we actually get it ourselves, but that's okay. Mercado Libre down just slightly on earnings. Google seeing a pump up to 76.40. These are good signs. Could be some just jitters on earnings. We don't 100% know, but so far so good. Meta seeing some green candles. Mercado Libre down 2%. That looks like they've gotten earnings. I don't know if we see negative 2% jitters. Hopefully Algo's just recently received the numbers and it's not terrible. Pray for me. Okay. I'm not seeing anything on earnings. Let me know if you guys got anything. Okay. Meta, Google 277 now. If someone knows something, it definitely looks good so far. Come on. I'm actually not getting anything right now. What the heck's going on? Come on. Okay, huge Google candle there. That must be earnings. That must be earnings. 281.71. Oh my God, 285. We're up 3%. Let's figure out what this is. Come on. Mercado Libre's earnings are out. Okay, I have Melly's earnings first. We'll go through them all. Down 4.8%. EPS missed by 11%. Revenue beat by 3%. They got $7.4 billion versus $7.2 billion, respectively. EPS is up 6% year over year. Revenue is up 39% year over year. But the stock is not convinced. Google, while hitting 285, fighting back a little bit. Oh my gosh, almost about to go red. Boy, oh boy, what a freaking swing. Google's numbers are out. Holy freaking crap. EPS 287, beat by 26%, and revenue $102 billion, beat by 2%. That's a double beat. EPS up 35% year over year, revenue up 16% year over year, even quarter over quarter, massive growth rates. 286, ladies and gentlemen, we got the lock. There we go. Big numbers, big numbers. Okay, let me go to their, we're going to try to get the other ones as well, but I need to get to their investor relations page, see if that is out just yet. Also, I'm going to check Fiscal AI because sometimes they can actually get the numbers before the IR does. So we're going to check that as well. Okay, holy freaking crap. Google's Q3, I have that number. I kind of want to see some of the other reports before we go reading through Google's numbers, but if none are getting reported, we'll just jump right into Google here. Google services. Oh my God. Google Cloud revenues increased 34% to $15.2 billion, led by growth in Google Cloud Platform across core products, AI infrastructure, and generative AI solutions. Net income increased 33%. EPS increased 35%. That's because they bought back shares. With growth across our business and demand for cloud customers, we now expect 2025 capital expenditures to be in the range of 91 to 93 billion. That's a huge bump to NVIDIA. Let me put NVIDIA's stock on this just ever so slightly up in the after hours. Microsoft down 4%. Let's try to figure out what the heck is going on there, but I cannot wait to listen to these Google numbers. What a freaking dip to buy this Google dip was. I mean, honestly, people said that this company was left for dead and that there was no recovery here. I just got Microsoft numbers. I'm seeing a double beat, not knowing what's going on. There must be some news attached to this earnings that has people a little confused. Earnings per share beat by 13%, $4.13 versus $3.66, expected. So 13% beat there. Revenue $77.67 billion, beat by 3%. So we ended up seeing good Microsoft numbers so far, but that doesn't mean that there wasn't a statement that was also made alongside earnings. So that doesn't tell us everything. So I'll find out what that is here in a second. But let's go back to Google. Ladies and gentlemen, are we going to hit freaking $300 today? Am I going to double my freaking Google position in 2025 alone? Oh my gosh. Year to date already, I mean, you've been able to buy shares at 142 and above this year alone. I mean, the flip is insane. We've doubled from 142 to 284, essentially, is what we're seeing now in after hours, sitting here at 292. Wow. Meta down 5.5%. Google is up 6%. I mean, we're seeing two big losses on Microsoft and Meta and just a clear winner today on the stock price. So far, things can change. So far, it is Google, 100%. What the sorry. Meta ended up getting $1 of EPS with $6.60 expected. They missed by 84%. And revenue, this must be something that I'm not understanding here. There must be something going on with Meta, but people are confused here. EPS is down 83% year over year, and revenue beat by 4%. Okay, let's get back to Google, though, because I don't want to look at the losers. Let's focus on the winners here. Oh, my gosh. Google, EPS, 287 versus 226 expected. That's up 35% year over year. Okay, revenue up 16% year over year. Google services up 14%. Advertising up 13%. That's an accelerated growth rate. We'll talk about this in a second. Search and other revenue, 15% year over year. I want to hear all the SEO guys and everyone come out of the woodwork and say that search is dead and everything's going to crap and everyone's going to ChatGPT and it's going to kill Google. Up 15% year over year. YouTube ads up 15%. Google Network decrease. We've been on a long-standing multi-year downtrend, multi-quarter. It's probably been 8 quarters at this point that Google's network revenue is decreasing. They're going to want to do more business within their network, not as much outside. It's good for companies like, Trade Desk or AppLovin or some of these names, but Google is going to slowly step away from that business, down 2.6% year over year. Google subscription, platform, and device revenue, ladies and gentlemen, up 21%. It's one of the largest companies in the world. Okay, they're $3.3 trillion business, essentially $3.5 trillion after today. And they're growing Google subscription platforms and devices, which could include Gemini as well, up 21%. Google Cloud revenue up 34%. Other bets, which includes Waymo and Wing and some of those other things, down 11% year over year. Okay, I don't think that's Waymo being down. I think that's a lot of other names being down, dragging down the total combined selection that Waymo is a part of. Okay. Operating income margins actually decreased by 1%. Operating margins decreased just ever so slightly. Google Cloud operating revenue increased 85% year over year. I'd love to see what that margin is exclusively. We'll need to open that up here in a second. CapEx guidance went from $85 billion to $92 billion. An additional $7 billion of future spend. That's going to go into NVIDIA's pockets. They're up ever so slightly in the after hours. Up 5%. Well, it's not all. Broadcom's there too. AVGO. Yeah, they're up ever so slightly as well. Because Google actually had some pretty interesting things this quarter. They're going to talk about it, but not only their TPUs, their tensor processing units that they use for their own chips or for their own capacity, but that they're actually going to be selling that to external customers, which just leads them to a whole other business use case, growth in cloud. We're going to see that continue on through into Q4. And listen to this. Holy shit. Google Cloud accelerated, ending this quarter with $155 billion in backlog. What are we talking about right now? Our full stack AI approach is delivering strong momentum. Gemini now processes 7 billion tokens per minute, and the Gemini app has over 650 million monthly active users. Wasn't it at 400 million last quarter? Okay, let's go. Quarterly dividend was declared at 21 cents a share, payable on December 15th. We continue to invest to meet customer demand and capture growing opportunities across the quarter. And Sundar Pichai also said Alphabet had a terrific quarter with double-digit growth across every major part of the business. We delivered our first ever $100 billion revenue quarter. Damn. Wow. Expectations was 99 billion. They did 102.3. Seeing a little bit of sell-off here while Microsoft and Meta end up recovering. You think there's any rotation play of like, okay, ServiceNow. Okay, sorry. Was I lost in the sauce? Transmedics down 10%. Where is ServiceNow? ServiceNow up 8%. And then where's Mercado Libre? As long as Mercado Libre is not dying, down 2%, yeah, it's a good day for me. Up 7, Google up 4%. I liked it better when it was 296, but maybe Sundar on the earnings call can recover that for us. Chipotle's earnings are out, in line completely. EPS at 29 cents. They expected 29 cents. Revenue expected at 3 billion flat. They got 3 billion flat. I mean, boring. ServiceNow, EPS beat by 13%. ServiceNow, where are you? ServiceNow. And revenue beat by 1%. EPS is up 30% year over year. Revenue up 22% year over year. Oh my gosh. Damn, man. Oh, really quick news coming out of crypto world real quick. Sorry, real pause. I know a lot of you guys are big fans of SoFi, because I'm a big fan of SoFi. MasterCard set to acquire crypto startup Zero Hash in a deal valued at nearly $2 billion. This company was actually one that SoFi just invested in. Not only are they a partner and own a minority stake in that business, which probably, just got acquired, but they're also a customer of Zero Hash. So we'll keep an eye on that and what that means for SoFi. But yeah, quick update there. Let's get back into the price changes. Meta down 6.2%. Let's go hunting and find out what the heck that EPS situation was. Starbucks, where is Starbucks? Up 3%. Beat on revenue. Growth of 5% year over year on revenue. And adjusted EPS was 52 cents. They expected 60 cents. So that was down 35% year over year. I don't follow Starbucks enough. I would think by my girlfriend's purchases that the sales would continue to increase. Same store sales growth at my local Starbucks is definitely going up. But no, they had 584 store closures in Q4 as part of a restructuring. That was not where I live, I guess. And revenue was up in North America by 3%. International revenue was up 9% year over year. And channel development revenue, which I don't even know what that is up 17% to $543 million. We'll have to find out. Let's see what the CEO said. We're in a year in our back to Starbucks strategy, and it's clear the turnaround is taking hold. Our return to global comp growth and momentum gives me confidence that we're on the right path. And the CFO, Kathy Smith, said Q4 was a milestone. our first quarter of global comp growth in 7 quarters, and we remain focused on driving top line while managing costs for durable long-term growth. It still is Q3 for them, but it's a fiscal Q4. So don't get confused by my wording there. It's just how they show it off, because it might be off by the same dated period, but it's still the same quarter. Okay. Let's find the Microsoft and Meta story. I haven't seen it posted just yet. Honestly, I'm seeing posting stronger than expected Q3 2025 earnings and a $77.7 billion quarterly revenue for Microsoft. They're down. Okay, let's talk about Meta first. I have Metas. Yeah, so the reason why EPS was $1 versus the $6 was a $15.9 billion one-time tax charge. Daily active persons was up 8% year over year to 3.54 billion. CapEx spend is still in line with the top end of their spend, but they increased the bottom end. So it was 66 billion to 72 billion. It's now 70 to 72 billion. Okay. So increase the bottom side of that guidance. Expenses also increased for guidance, and 2026 CapEx expected to grow notably larger year over year due to an AI infrastructure expansion. Why is this not pumping NVIDIA and Broadcom in these names? Every single one of these large tech companies is just saying, hey, we're going to spend more and more and more and more, and it's not moving NVIDIA. Maybe we've, ran up enough today as it is, up 3%, but yeah, exactly, Prox. So basically, nothing changed. Things are pushing forward. Segment highlights, they said family of apps did $50.7 billion of revenue. They expected $49 billion. Reality Labs operating loss was $4.4 billion. They expected $5.2 billion. So that's even better than expected. And Reality Labs revenue was not disclosed, but Q4 guide implies year-over-year decline due to product cycle. Let's see here. Excluding the tax charge. Okay, so excluding the tax charge, they expected $6.6. They got $7.25 if they didn't have that tax charge. So we only got $1, but they really could have accepted $7.25. Headcount, 78,450, up 8% year over year. Average price per ad is up by 10% year over year. The amount of ad impressions is up 14% year over year. CapEx came in at 19.4 billion, free cash flow at 10.6 billion. Their cash and cash equivalents, 44.5 billion, and they repurchased $3 billion of shares and dividends of 1.3 billion. I mean, Meta's a giant. Be down 6%. I mean, do what you got to do. This is a strong quarter. Mark Zuckerberg said, we had a strong quarter for our business and our community. Meta Superintelligence Labs is off to a great start, and we continue to lead the industry in AI glasses. If we deliver even a fraction of the opportunity ahead, the next few years will be the most exciting period in our history, says a $2 billion business. We expect strong ad revenue growth in Q4, particularly offset by lower Reality Labs revenue, and notes aggressive investment in AI infrastructure, both in-house and third-party cloud. Sweet. Love it. They warn that full year 26 CapEx and expenses will accelerate meaningfully due to AI compute and compensation growth. That's what this is. The sell-off has to be that. They said they're going to spend more and invest more into the future. The more value-esque investors do not like the sounds of that. If you guys truly do believe in their vision of artificial intelligence, of AI glasses, and what that means for the future, I think that this is just a dip worth buying. If you're a believer, 7% down for the quarter that we're seeing, let's get real. Highlighted potential regulatory headwinds in the EU. This could also be part of it. Less personalized ads and US youth-related trials in 2026 as well. That's also going to bug investors. Okay. Let's find Microsoft. Sorry for the delay, ladies and gentlemen, but we got to get to them one by one. Microsoft, by the way, Google pushing back above 290. Microsoft down 2.9%. Wolfspeed, actually, let's see their company really quick. They also reported earnings down 6%. Double beat. EPS came in at a beat of 23%. I was not expecting them to be down so much. Okay, Microsoft. I have Microsoft's report here. Revenue is up 18% year over year. EPS also beat. That's up 13% year over year. Double beat. Segment level growth, personalized computing revenue beat. That's up 4% year over year. Microsoft Cloud, 26%. Intelligence Cloud, 28%. Azure and other cloud services, 40% year over year. Productivity and business processing growth up 17% to $33 billion. Microsoft 365 commercial cloud up 17%. Commercial or consumer cloud 26% year over year. I mean, these companies are legitimately the most dynamic, fast-growing, unbelievable businesses. If you guys are looking for quality, and this is not, I'm not trying to state this, but I think so many people are always looking for these small companies that can have massive pops. But then if you're worried about a bad market, those are the ones that get crushed. These companies are dealing in 100+ different countries in multiple different currencies. Whenever you're buying a Microsoft or a Meta or a Google, you're essentially buying an index. Like, you're getting so many different segments. You're getting so many different business lines. You're getting different customers, different geographics, different politics. It is amazing. LinkedIn revenue up 10%. Dynamics 365 revenue up 18%. Windows OEM and devices up 6%. Search and news ads up 16% year over year. What are we talking about? They returned $12.7 billion versus dividends and buybacks in this quarter. These companies are giants, man. Meta, we just covered them. Go back, in the stream, maybe 10 minutes before, 8 minutes before. Nothing looks terribly wrong. I think the reason why they're dipping so much is they said that they're going to put so much back into future growth. They said CapEx is going to increase, and they're having some regulatory problems with the EU. When does big tech not get a freaking headache from the EU? So that is a constant. Okay. So they look great. Everything looks great. These companies are giants. Our planet scale cloud and AI factory together, by the way, I'm talking about Microsoft, sorry. Our planet scale cloud and AI factory together with co-pilots across high value domains is driving broad diffusion and real world impact, said Satya Nadella. Strong start to our fiscal year. Microsoft Cloud strength reflects growing customer demand from our differentiated platform. That was the CFO, Amy Hood. And then let's see what else here. Non-GAAP results for Microsoft are excluding the impact from the investments in OpenAI, which, if you guys saw through it the last week, that was pretty impactful. They have a 27% share now of OpenAI. It's been essentially a 100-bagger for them. So that's been quite good. And constant currency growth revenue was 17% year over year, operating income 22%, and GAAP EPS 11% year over year. These are, honestly, these are good quarters across the board. Having an 8.6% drawdown on Meta, like, I might buy this dip right now. That is such a dumb... Well, actually, hold on. Because if I'm to think back, Meta, Mark Zuckerberg loves going very, very heavily into large investments. He might be one of the greatest CEOs of all time. Whether or not you guys think that he's a lizard person or whatever, or that, you don't find him very personable, you have to realize how young he is and the size of the business that he created from scratch in his dorm room. I mean, that is a one of one. There's very, very few people that have ever replicated what he's done in that amount of time. That said, He does overly invest in what he believes in, like the metaverse, and going so heavily into that. And that brought the stock all the way down to $88 in very quick succession over a couple quarters from him overspending. Okay. Then we had Altimeter Capital and Brad Gerstner send a letter to say, hey, you need to stop and have some fiscal responsibility in your business. And then that led us to where we are. So can there be rough times ahead if people think that he's spending without a real return going forward? Absolutely. But am I a believer, as a native glasses wearer, that AI glasses is going to be a thing? Absolutely. Okay, I would love to have a HUD in front of my face that gives me updates on the news, the direction that I'm walking, all of these cool things, take pictures of things in real time. I mean, I would look at that as a benefit to my life. Does everyone think that way? No. But this might be a dip that I end up buying. I'll listen to the earnings, maybe even after Google's. We will be listening to Google's earnings, okay? Up 5.3%. We did cover that as well, but we're going to get more into that. It just looks stunning. I mean, they just are knocking it out of the board, or knocking it out of the park. Sorry. My sports references are definitely not great. ServiceNow. Okay. Another company in the portfolio, up 4.7%. It's a lucky day today. Revenue is up 22%. Subscription revenue up 21.5%. EPS ended up getting $4.82 with expectations at $4.26. That's a 27% year-over-year beat. Or sorry, not beat, but change. Free cash flow margins improved. Operating margins improved. And guidance also, they increased from $12.8 billion to $12.85 billion. That also beat expectations. Subscription revenue beat expectations for guidance. So it was a triple beat across the board. They announced, they announced a 5-for-1 stock split pending shareholder approval. That'll be approved. That's December 5th. Which it doesn't mean much. I mean, the ownership that you own in that company will stay the same, but just from past performances on stock splits, it usually does well for the company. It allows people to do more options trading on that stock, so people can have a little bit more flexibility with the way that they trade ServiceNow. They're expecting 250 basis point year-over-year expansion in full year 2025 free cash flow margin and a $584 million share repurchase in Q3 with $2 billion remaining under authorization. Okay. Very, very cool. They're deepening the relationship with NVIDIA, collaborating with FedEx DataWorks to build an AI-powered supply chain workflow. Announced new AI Institute in West Palm Beach, Florida, 850 new jobs, $1.8 billion economic impact. Looks great from ServiceNow. Bill Dumont said, the CEO said, this outstanding Q3 performance is the cleanest demonstration yet that ServiceNow is the AI platform for business transformation, and that every enterprise in every industry is focused on AI as the innovation opportunity of our generation. That is a strong statement. Q3 was an exceptional quarter with outstanding performances across the board. And massive platform demand and AI-driven efficiencies reinforce our ability to scale with accelerating margin expansion. Very strong name. Very, very strong name. I think people sometimes loop in, Salesforce and ServiceNow, but if you look over the past few years, there's been a clear difference in execution. And ServiceNow is worth the premium, or at least that I've seen. I like buying the fastest movers for sure. Ex Palantir. Okay. Let's see. Transmedics down nearly 8%. Let's see. Do I have a report on TMDX? Do I? I don't know if I do. If not, that might give us time to go through Google's press release. Maybe we'll, jump into Google's press release, by the way. Currently sitting at 292, up 6%. Meta down 8.5%. I really kind of want to play these earnings. Like, I don't know. What are we doing? Chat? I think it's because the amount that they're spending. But for me, my largest position in my portfolio is NVIDIA. So do I even hate it? Like, let Meta spend everything that they want to. Microsoft's trying to recover. Oh, yeah. Yeah, from 513, if you guys ended up buying that dip, that was that looks to be fine. Most of these companies, I think, will end up just continuously growing, getting larger. Is Google also pushing for both Google and Microsoft? I'm buying Meta. Do not follow me into this trade. I'm not suggesting that I'm doing the right thing at all. I'm not a swing trader. I'm not a usual dip buyer like this. So don't think that this comes with any sort of expertise or suggestion. I'm not good at this, but I'm gonna buy a few shares. Okay. Let's see here. Okay, sorry. I was just buying a little Meta. We'll see. And if it ends up dipping even more, I might double down. No. There's always someone in chat. No. Please don't. It was a small buy. Don't you worry. I'll be fine. I didn't sell anything to buy it. Disney finalized the deal with Fubo this morning, and Fubo is down. I thought I saw them. They were like up a ton. Up 1%. Maybe it was priced in. I don't know anything about Fubo. I got a buddy who's really into it. But yeah. Honestly, I've been having a little bit of a, like, I don't know the right word, just like I want to say a come to Jesus moment. That's not appropriate, but like just realizing that buying quality names just works. You know, it's just so easy. They're the easiest sleep at night investments. And that's why whenever I find that you get these insane dips, like Meta down 9% right now, like, do you think I'm going to regret this over the long term, buying one of the strongest businesses in the entire world? Whole focused on artificial intelligence, getting into the new hardware game. It's enlightenment. It is. It's enlightenment. You can make a ton of money buying NVIDIA, Google, Amazon, Meta, Microsoft. I mean, these are quality names, and they only seem to strengthen. Ghost says no. All right, well, hey. That's all right. Let's go ahead and take a little deeper look-see at Google really quick. I promise you guys we will return to those stock prices here in a second, then listen to the call, which should be coming up at 5 o'clock. I'm going to try to get the price of Google with the earnings call at the exact same time, but for real, no promises. And I know that sounds crazy, but the platform that I'm using just sucks. Okay. Google's revenue up 16%. That's an acceleration year over year. This is a dying business, by the way. Everyone, just a reminder, we were at $140 a share, and there were essentially short reports being put out on Google about how they're going to get crushed by ChatGPT. So faster year over year growth, little bit of operating margin compression. Let's find out what that was from on a year over year basis. Google services revenue is YouTube search and other YouTube, Google Search, Google Network, and subscription. And yeah, YouTube, man, 15% year over year. That's incredible. I mean, my channel's grown a little bit, but I don't know if I've impacted them that much. Google search up 15%, $56.5 billion in search. This is a dying business. I mean, come on, like that. These are clear signs of a dying business. And subscription platforms and devices is now 12.8 billion. I honestly think you're going to see Google Network over a longer period of time essentially just continue to decrease. Okay. Google Cloud, though, completely separate business. Growth rate 34% this quarter. Absolutely insane. Margin improved to 23.7% on an operating margin. And if you guys are NVIDIA shareholders, who doesn't like that? Capital expenditures. You guys are blocking it a little bit. It's still kind of blocking it, but you guys can see at least 83% year over year growth. Like, where's the slowdown? Like, we're not buying NVIDIA because people think that eventually there's going to be a slowdown. The rate of acceleration continues to increase. 83%, $24 billion spent on property and equipment. That includes chips. Okay. Free cash flow also saw a big increase, even with the massive increase in capital expenditures. We still saw a massive increase in free cash flow. Last quarter, it got killed, $5 billion. So that kind of hurt the stock a little bit that day, but that recovered here, up year over year 39%. If you can grow free cash flow while spending this much on chips, I mean, you don't really need to change much. Okay, get me out of this, and let's go back to the stocks real quick. Sorry, you guys have to look at my big head for a second. Won't be too long. I mean, did we buy the dip or did we buy the dip? Tell me. Did I time that perfectly or what? I essentially bought on this candle. We'll see. We'll see if it holds. Okay. We got in at 286. Or sorry, not 286. 686. We'll see if it holds. And you guys said I wasn't a swing trader. I mean, I could have got 682 maybe, but you know. Okay, Google up 5%. Earnings are in, what is that? 22 minutes. So we have some more news to go through. Let's make sure that we're getting everything. eBay ended up seeing a slight double beat for the. I know. Hey guys, by the way, eBay still exists. We're talking about like the best businesses in the world, and then, it doesn't mean that they're not a good investment. There might be a buying opportunity. The PE on eBay before earnings was 22 times. For Meta, it's 27 times. But yeah. Love eBay. All right. Well, I'm sorry I knocked it. eBay is dead in Europe. Isn't it for like trading cards and like a lot of collectibles now? Like that's really what the market is for eBay? Or am I wrong on that? I don't cover it. Let's check out Carvana. Where is Carvana today? Down 4.5%. Honestly, it's weird. There is a lot of blood today in these types of names. Like Wolfspeed down 7, nearly 8%. Transmedics down nearly 8%. KLA down 3%. eBay down 7. Carvana down 4. Microsoft down 2. Meta down 7. And Chipotle down 5. I mean, you had to be quite selective this day. Google worked. ServiceNow worked. And what else? I know there was another one. Starbucks, maybe. Was it really the two companies that I was that I'm holding. For real, guys, this has never happened to me in my entire life. Usually it's the companies that I'm covering. Those are the red ones. Okay. Carvana, however, EPS came in at $1.03, missed by 25%. Revenue ended up beating by 11%, $5.65 billion in revenue. They expected $5.1 billion. So that's the quick numbers on Carvana, down 5%. And but they recovered from their lows. If you were able to get $305, I mean, that might be the dip to buy. Let's see if we can find anything on Carvana here, not just top and bottom line. Okay, Carvana ended up seeing, some beats here. Outlook for the company ended up saying at least 2.2 billion. The previous estimation for full year 2025 for adjusted EBITDA was 2 to 2.2 billion. Now they're saying at least 2.2 billion. So they're putting their above their old high end target. Q4 retail units expected to be 150,000. We drove record growth and profitability, crossing a $20 billion revenue run rate for the first time, said the CEO, and our vertically integrated model continues to strengthen our competitive edge in speed, selection, and efficiency. Okay. Revenue run rate exceeded $20 billion for the first time. Net income margin was 4.7%, and GAAP operating income was $552 million, a margin of 9.8%. It doesn't sound all that bad for the Carvana bulls. I mean, only down 4% now, recovering from that quick candles. Stocks usually take the elevator down, take the stairs back up. Meta recovering. Maybe that was it. Maybe that was the time to buy. Well, I mean, it still is. It's not like we're far away from, 682 to 700 is essentially the same price looking over the grand scheme of things. It's like a 1% move. Google up 4.8%, 4.7%, 288 right now, about to get into earnings in the next 18 minutes. And we have a line as well. Let's see this one. A line ended up showing off earnings. They're up 15.4%. Well, I lied. This is the real winner today. Revenue was up 1.8% year over year. EPS was up 7.6% year over year. Share buybacks, cash increased quarter over quarter. Guidance improved. CEO Joe Hogan said Q3 results came in above our outlook on both revenue and margin. Growth was led by EU, APAC, and LATAM, or in Latin America markets, especially in teens and kids. Restructuring efforts and new digital initiatives like ClinCheck Live Plan will strengthen profitability and market positioning. I'm not in any of those types of names, but in case you guys are, let's see what else we have. Waystar Holdings, essentially flat, and essentially, up 7%, but $3 billion company. All right. Wow, Mercado Libre ended up seeing quite the recovery here, 2,100 to 2,270. Okay, seeing a little bit of recovery there. Meta still down 7%. Google down 5%. First name, last name is doing a short Meta YOLO. Do not do that. Is the Meta call going on right now? We could only listen to about 30 minutes of it. I don't think they're here. Wait, hold on. No, their call's not going on. It's probably at 5 o'clock. Google's call is at Google's call is also at 5 o'clock. Bear with me a moment while I pull this up. Webcast for Meta. No, no, their call is going on. Do you guys want to listen to it? We can turn it on. Um, okay.
with $44.4 billion in cash and marketable securities and $28.8 billion in debt. Turning now to the business outlook, there are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, daily actives continue to grow year over year across Facebook, Instagram, and WhatsApp. We're continuing to see improvements to our products and recommendations drive incremental engagement, with year-over-year growth in global time spent accelerating on both Facebook and Instagram in Q3. In the US, overall time spent on Facebook and Instagram grew double digits year over year, driven by continued video strength as well as healthy growth in non-video time on Facebook. The engagement gains continue to be driven by product work and ongoing improvements to our recommendation systems as we optimize our model architectures, implement advanced modeling techniques, and integrate more signals about people's interests. We also continue to focus on increasing the freshness of recommended content. On Facebook, our systems are now surfacing twice as many reels published that day than at the start of the year. Looking to 2026, we expect to advance our recommendation systems across several dimensions. On Instagram, one focus is evolving our systems to surface content across a broader set of topics that cater to the diverse interests of each person. This follows a similar approach we've implemented on Facebook that has driven good results. We also expect to make significant progress on our longer-term ranking innovations in 2026. We're seeing promising new results from our research efforts to create foundational ranking models and expect the new model innovations we're developing as part of this will enable us to significantly scale up the amount of data and compute we use to train our recommendation models in 2026, yielding more relevant recommendations. Another large focus next year is leveraging LLMs to improve content understanding. We expect this is going to enable our systems to more precisely label the keywords and topics within videos and posts, which will allow our systems to both develop deeper intuition about a person's interests and retrieve the content that matches them. Finally, we're making good progress with Meta AI and Threads. The number of people using Meta AI across our family of apps continues to grow, and we're increasingly leveraging first-party content into Meta AI results, with the majority of Meta AI's responses to Facebook deep dive queries in the US now showing related reels. We're also seeing a lot of traction with media generation. People have created over 20 billion images using our products, and since launching Vibes within Meta AI in September, we've seen media generation in the app increase more than tenfold. On Threads, we see strong growth in both daily actives and the depth of engagement as we continue to improve recommendations. The ranking optimizations we made in Q3 alone drove a 10% increase in time spent on Threads. We also continue to ship new features, including launching direct messaging in Q3, so anyone on Threads can now message one another within the app. Now to the second driver of our revenue performance: increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. We continue to refine ad supply across each of our major surfaces within Facebook and Instagram to better deliver ads at the time and place they are most relevant to people. Longer term, we have exciting ad supply opportunities on both Threads and WhatsApp status. Ads are now running globally in feed on Threads, and we're following our typical monetization playbook of optimizing the ads formats and performance before we ramp supply. Within WhatsApp status, we're continuing to gradually introduce ads and expect to complete the rollout next year. The second part of increasing monetization efficiency is improving marketing performance. Advancing our ad systems remains a critical aspect of this work, and we are driving performance gains through ongoing improvements in our larger scale ads ranking models. For example, we continue to broaden the adoption of Lattice, our unified model architecture. In Q3, we rolled out Lattice to app ads, which drove a nearly 3% gain in conversions for that objective. Since introducing Lattice back in 2023, along with other backend improvements, we have now cut the number of ads ranking and recommendation models by approximately 100, as we consolidated smaller and more specialized models into larger ones that use the Lattice architecture to generalize learnings across surfaces and objectives. We continue to observe performance improvements as we combine models and expect to drive additional gains as we consolidate another 200 models over the coming years into a smaller number of highly capable models. In addition to advancing our foundational ads models, we're innovating on our runtime models we use downstream of them for ads inference. For example, we began piloting a new runtime ads ranking model in Q3 that leverages more compute and data than our prior models to select more relevant ads. In testing, we've seen this new model drive a more than 2% lift in conversions on Instagram. We also significantly improved performance of Andromeda in Q3 by combining models across retrieval and early stage ranking into a single model, driving a 14% increase in ads quality on Facebook surfaces. Within our ads products, we're seeing continued momentum with Advantage Plus. In Q3, we completed the rollout of our streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers running sales, app, or lead campaigns have end-to-end automation turned on from the beginning, allowing our systems to look across our platform to optimize performance by automatically choosing criteria like who to show the ads to and where to show them. The annual run rate of revenue running through our end-to-end automated solutions has now reached $60 billion following the implementation of the new streamlined creation flow, as we continue to see more advertisers leverage the performance benefits of our solutions. Within our Advantage Plus Creative Suite, the number of advertisers using at least one of our video generation features was up 20% versus the prior quarter, as adoption of image animation and video expansion continues to scale. We've also added more generative AI features to make it easier for advertisers to optimize their ad creatives and drive increased performance. In Q3, we introduced AI-generated music, so advertisers can have music generated for their ad that aligns with the tone and message of the creative. Finally, business messaging remains a significant opportunity for us. We're seeing strong growth across our portfolio of solutions, including with click-to-WhatsApp ads, which grew revenue 60% year over year in Q3. We're also making good progress on our business AI efforts, where we've been focused on building a turnkey AI that helps businesses generate leads and drive sales. We've been opening access in recent months to more businesses within our initial test markets, the Philippines and Mexico, and have seen strong usage with millions of conversations between people and business AIs taking place since July. This month, we expanded availability within WhatsApp and Messenger to all eligible businesses in Mexico and the Philippines, respectively. In the US, we're also starting to roll out the ability for merchants to add their business AIs to their website so we can support the full sale funnel from ad to purchase. Next, I would like to discuss our approach to capital allocation. Our primary focus is deploying capital to support the company's highest order priorities, including developing leading AI products, models, and business solutions. As we make significant investments in infrastructure to support this work, we are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead. We're doing so in several ways, including staging data center sites so we can spring up capacity quickly in future years as we need it, as well as establishing strategic partnerships that give us option value for future compute needs. The strong financial position and cash generation of our business enable us to make these investments while also accessing additional pools of cost-efficient capital. Moving to our financial outlook, we expect fourth quarter 2025 total revenue to be in the range of $56 to $59 billion. Our guidance assumes foreign currency is an approximately 1% tailwind to year-over-year total revenue growth based on current exchange rates. Our outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in Q4. The anticipated reduction in Reality Labs revenue is due to us lapping the introduction of Quest 3S in Q4 of last year, as well as retail partners procuring Quest headsets during Q3 of this year to prepare for the holiday season, which were recorded as revenue in the third quarter. Turning to the expense and CapEx outlooks, I'll first start with 2025 before providing some commentary on our planning for 2026. We expect full year 2025 total expenses to be in the range of $116 to $118 billion, updated from our prior outlook of $114 to $118 billion, and reflecting a growth rate of 22 to 24% year-over-year. We currently expect 2025 capital expenditures, including principal payments on finance leases, to be in the range of $70 to $72 billion, increased from our prior outlook of $66 to $72 billion. On to tax. Absent any changes to our tax landscape, we expect our fourth quarter 2025 tax rate to be 12 to 15%. Turning now to 2026. We are at an exciting point for our company, where we have continued runway to improve our core services today, as well as the opportunity to build new AI-powered experiences and services that will transform how people engage with our products in the future. We expect the set of investments we're making within our ads and organic engagement initiatives next year will enable us to continue to deliver strong revenue growth in 2026, while our progress on AI models and products will position us to capitalize on new revenue opportunities in the years to come. A central requirement to realizing these opportunities is infrastructure capacity. As we have begun to plan for next year, it's become clear that our compute needs have continued to expand meaningfully, including versus our own expectations last quarter. We are still working through our capacity plans for next year, but we expect to invest aggressively to meet these needs, both by building our own infrastructure and contracting with third-party cloud providers. We anticipate this will provide further upward pressure on our CapEx and expense plans next year. As a result, our current expectation is that CapEx dollar growth will be notably larger in 2026 than 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth primarily driven by infrastructure costs, including incremental cloud expenses and depreciation. Employee compensation costs will be the second largest contributor to growth, as we recognize a full year of compensation for employees hired throughout 2025, particularly AI talent, and add technical talent in priority areas. Finally, we continue to monitor active legal and regulatory matters, including the increasing headwinds in the EU and the US that could significantly impact our business and financial results. For example, in the EU, we continue to engage constructively with the European Commission on our less personalized ads offering. However, we cannot rule out the Commission imposing further changes to that offering that could have a significant negative impact on our European revenue as early as this quarter. In the US, a number of youth-related trials are scheduled for 2026 and may ultimately result in a material loss. In closing, this was another good quarter for our business. We have an exciting set of opportunities to continue improving our core business while delivering innovative new experiences and services for the people and businesses using our products in the years to come. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. To ask a question, please press star one on your touchtone phone. To withdraw your question, again, press star one. please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have two for Susan. The first one, Susan, so the pipeline for core improvements to come in 26 with models and ad ranking models and more types of compute seems very exciting, and the infrastructure build seems sizable behind that. So can you help us a little understand some of the early quantifiable signals you're seeing on A/B tests from some of these improvements to come that sort of make you most excited and give you confidence you're going to get ROIC from all this CapEx? That's the first one. Second one's a little faster. How large is the Reality Labs revenue headwind in the 4Q guidance? Thanks.
Thanks, Brian, for the question. I think your first question had a couple parts to it, so I'm going to try to disaggregate those parts and let me know if this addresses what you're getting to. I will say that the growth in 2026 CapEx relative to 2025 comes from growth in each of the core areas, MSL, core AI, as well as non-AI spend. So all of those areas are growing, but the MSL AI needs are growing the most. In terms of the core AI pipeline, I think we talked about last year when we were going into the 2025 budget process, we had a roadmap of resource investments across both headcount and compute that we thought would pay off, in 2026. And it's really a very broad range of sort of different ads ranking and performance efforts. And we're continuing to see that, those have paid off through the course of the year. There is a long list of specific efforts, but one of the measures that we look at to monitor this is how are we driving ad performance? How are conversions growing? Conversions is a complex metric for us because advertisers optimize for so many different conversions with different values. But when we control for that and look at value-weighted conversion rates, we're seeing very strong year-over-year growth, and weighted conversions continue to grow faster than impressions. We also talked about some of the new model architecture over the course of the year and the degree to which the new model architecture is enabling us also to take advantage of having more data and more compute to drive ads performance. So we expect that that's going to be a continued story in 2026. We are, in fact, at the beginning of our 2026 budgeting process now, and we, see a similar list of revenue investments that we're excited to be able to invest in. And so we think that that's going to be a big part of our ability to continue to drive strong revenue performance throughout the year. On your second question, which is the Reality Labs revenue headwind, I don't think we have quantified the exact size of that. We expect that Q4 Reality Labs revenue will be lower than last year for a couple reasons that I alluded to. The biggest factor is we're lapping the introduction of Quest 3S in Q4 of last year, and we don't have a new headset in the market this year. We also recorded all of our holiday-related Quest 3S sales in Q4 24 since the headset was launched in October 24. This year, we're recognizing some of those Quest 3S sales in Q3 as retail partners have procured Quest headsets in advance of the holiday season. We're still expecting significant year-over-year growth in AI glasses revenue in Q4 as we benefit from strong demand for the recent products that we've introduced, but that is more than offset by the headwinds to the Quest headsets.
Your next question comes from the line of Doug Anmuth with JP Morgan. Please go ahead.
Great. Thanks for taking the question. I appreciate the strategy to front load capacity for superintelligence. Can you just talk about your thought process in kind of triangulating the CapEx dollar growth and the significantly faster expense growth next year with core growth in the business, and then the impact on earnings and free cash flow? And do you have targets that we should be thinking about for cash on hand or net cash overall? Thanks.
Thanks, Doug. We're Right now, I would say in the process of we're relatively early, actually, still in the process of putting together our budget for 2026. And it is on the capacity side a particularly dynamic process. We're certainly seeing that we wish we had more capacity today than we do. We would be able to put it towards good use. Certain not only would the MSL team appreciate having more capacity, but we'd be able to put it towards good and ROI positive use in the core business as well. So we're really trying to plan ahead, not only to ensure that we have the capacity we need in 2026, but also to give ourselves these sort of flexibility and option value to have the capacity that we think we could need in 27 and 28. So that said, there are lots of moving pieces in the budget. It's not baked yet. It's still sort of in the process of coming together. We don't have, specific targets to share, but we do feel like, our strategic priority is really making sure that we have the compute that we need to be well positioned to succeed at AI, and that's sort of the foremost priority as we're putting together the budget.
Yeah, I mean, I'll add a few thoughts on this too. Although, as Susan said, we're still working through the actual budget, and I think we'll typically have more to share on that early next year. But to date, we keep on seeing this pattern where we build some amount of infrastructure to what we think is an aggressive assumption, and then we keep on having more demand to be able to use more compute, especially in the core business, in ways that we think would be quite profitable, than we end up having compute for. So I think that suggests that being able to make a significantly larger investment here is very likely to be a profitable thing over some period, because if the primary use of it is going to be to accelerate the AI research and the new AI work that we're doing and how that relates to both the core business and new products. But any compute that we don't need for that, we feel pretty good that we're going to be able to absorb a very large amount of that to just convert into more intelligence and better recommendations in our family of apps and ads in a profitable way. Now, I mean, it's of course possible to overshoot that, right? And if we do, I mean, this is what I mentioned in my comments, then, we see that there's just a lot of demand for other new things that we would build internally, externally. Like almost every week, people come to us from outside the company asking us to, stand up an API service, or asking if we have different compute that they could get from us. And we haven't done that yet, but obviously, if you got to a point where you overbuilt, you could have that as an option. And then, the kind of the very worst case would be that we effectively have just pre-built for a couple of years, in which case, of course, there would be some loss and depreciation, but we'd grow into that and use it over time. So my view on this is that rather than continuing to be constrained on CapEx and feeling in the core business like we have significant investments that we could make that we're not able to make that would be profitable, that the right thing to do is to try to accelerate this to make sure that we have the compute that we need, both for the AI research and new things that we're doing, and to try to get to a different state on our compute stance on the core business. So that's kind of how I'm thinking about that overall. Of course, there's a lot of operational constraints too on what one can build, right? So we're basically trying to work through this all, and I think we'll have more to share in the coming months and over the course of next year. But I think that there's just a huge amount of opportunities ahead here.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks so much for taking the question. Mark, wanted to reflect on some of your comments with respect to scaling towards superintelligence and bringing it back to consumer AI. Maybe reflect a little bit on the signals you've gotten on the way consumers across family of apps interact with Meta AI today, and how you think about scaling and exiting models from the superintelligence effort might change the utility and behavior around Meta AI in the years ahead. Thanks.
Yeah, I mean, a lot of people use Meta AI today. I mean, as I said in my comments up front, there's more than 1 billion people who use it on a monthly basis. And what we see is that as we improve the quality of the model, primarily for post-training Llama 4 at this point, we continue to see improvements in usage. So our view is that when we get the new models that we're building in MSL in there and get like truly frontier models with novel capabilities that you don't have in other places, then I think that this is just a massive latent opportunity, right? We know, I mean, I would guess that, Meta, I think, has the best track record of any company out there of taking a new product that people love and getting it to billions of people in terms of usage. So I think that the ability to plug in leading models is going to, I would predict, lead to a very large amount of use of these things over the coming years. So I'm very excited about that in terms of new products. It's not just Meta AI as an assistant. I think that there are going to be all kinds of new products around different content formats, and we're starting to see that with video and content creation. But I think that there's going to be a lot more like that I'm quite excited about. And then there are the business versions of all of these too, like business AI, and then that's of course one part of the story is the new things that will be possible to build, and then the other part is how more intelligent models are just going to improve the core business and improve the recommendations that we make across the family of apps and improve the recommendations and advertising. And I think there's just as we've shown, there's sort of this very large amount of headroom, and the opportunity there keeps growing as we as we are improving and optimizing the AI there. And I think that really shows no sign of being near the end. I think that there's quite a bit more to do there. And like I said in response to the last question, we are sort of perennially operating the family of apps and ads business in a compute starved state at this point, which is on the one hand sort of an odd thing to say given the compute that we've built up, but we really are taking a lot of the resources and using them to advance future things that we're doing. And we think that there's a lot more compute that we could put towards these that would just unlock a huge amount of opportunity in the core business as well.
Your next question comes from the line of Mark Shmulik with Bernstein. Please go ahead.
Yes, hi, thanks for taking the questions. Susan, as you think about the visibility into kind of the runway next year of continued ad performance and engagement improvements, how do you think about kind of the scale of those improvements versus kind of the progress we've seen over the last 2 years? And then Mark, as you think about kind of the timing of some of these newer efforts coming out of Superintelligence Labs, is us anchoring to kind of an updated frontier model launch sometime next year, like the right way for us to think about it? Or should we be looking at kind of progress from new products you're excited to see ship like Vibes? Thank you.
Thanks, Mark. So on the sort of ads improvement side, some of the innovations that we have been launching actually, involve sort of improving our larger scale models. So we, don't use our larger model architectures like GEM for inference because their size and complexity would make it too cost prohibitive. The way that we drive performance from those models is by using them to transfer knowledge to smaller, lightweight models that are used at runtime. And then in addition to the foundation model work, we are working on advancing our inference models by developing new techniques and architectures that then allow us to scale up compute and complexity in an ROI positive way. So in general, we obviously have a very large base of advertisers. There's a lot of demand liquidity in the system, and even small scale improvements that we are able to make in terms of driving basis point improvements in the performance of ads or single digit increases in conversions relative to impressions in a given quarter off of a large base mean that we're really able to continue to grow the absolute dollars of revenue growth in a pretty meaningful way.
Your next question comes from the line of Justin Post with Bank of America. Please go ahead.
Actually,
Thank you.
hey, Justin, just give us 1 second. I think there was a second part
Sure.
of Mark's question that we just want to get to on MSL.
Yeah, I mean, I'll keep it quick. I mean, I don't think we have any specific timing to announce certainly on the models or products, but I expect that you will see both. We expect to build novel models and novel products, and I'm excited to share more when we have it.
Krista,
Justin, please go ahead.
Great, thanks. Mark, you mentioned the prior two content cycles, and obviously you've been able to generate very attractive margins on them. As we get into the AI cycle, obviously some concerns on the investment, but can you talk a little bit about how you're thinking about, tools that could be coming out for users? I know there's some new competition. And then secondly, how you think about margins in this content cycle? Any reason to think they would be different versus prior cycles? Thank you.
I think it's too early to really understand what the margins are going to be for the new products that we build. I mean, I think certainly each product has somewhat different characteristics, and I think we'll kind of understand how that goes over time. I mean, my general goal is to build a business that maximizes value for the people who use our products and maximizes profitability, not margin. So I think we'll kind of just try to build the best things that we can and try to deliver the most value that we can for most people. I don't know.
Your next question comes from the line of Ross Sandler with Barclays. Please go ahead.
Great. Hey, Mark, some of the goals for competing AI labs are around achieving AGI or these other milestones that are kind of like out there and a little esoteric. How are you setting up your new team in terms of achieving those types of goals versus products that can generate revenue from Meta kind of right out of the gate? And is the goal that you had articulated to us previously around giving, billions of people kind of a personal AI to use, still the direction of travel that you see, or is there, other things like kind of this Vibes or Sora angle that you think are potentially important? How should we think about like the overall direction? Thank you.
Sure. So the way that I think about this is that the research is going to enable new technological capabilities to exist. And then those capabilities can get built into all kinds of different products. So the ability to reason more intelligently is, for example, very important across a large number of things. It would be useful for an assistant. It will also be useful in business AI. It will also be useful in the AI agent that we're building to help advertisers figure out what their campaigns are going to be. It will also have implications for eventually how we do ranking and recommendations of people's feeds and make different decisions there. That's just one example. I mean, certainly the capability to be able to produce very high quality, good video is going to be useful for giving people new creative tools. It will help increase the amount of content inventory that can be shown in Instagram and Facebook, and therefore should enable an increase in engagement there. It should help advertisers be able to create creative that will help us monetize better. So you can just go kind of down the list of capabilities that you'd expect. And I think each one will enable a bunch of different things. And I think the art of product development here is looking at the list of technology capabilities and figuring out what new products are going to be useful and prioritizing those. But fundamentally, I would sort of expect this exponential curve in new technology capabilities that are going to become available. And the other thing that I expect is that I think being the best in a given area will drive great returns rather than, this is not like a check the box exercise of like, okay, we can generate some kind of content and someone else can. I think that like the company that is the best at each of these capabilities, I think will get a large amount of the potential value for doing that. So there are lots of different capabilities to build. I'm not sure that any one company is going to be the best at all of them. I doubt that's going to be the case. But a lot of what we're trying to do is not kind of do some things that others have done. We're really trying to build novel capabilities. And I'm keeping this high level because I don't want to necessarily from a competitive or strategic perspective get into what we're prioritizing. But that hopefully gives you a sense of how we're thinking about what we're doing. We want to be able to kind of build novel things, build them into a lot of our products, and then have the compute to scale them to billions of people. And we think that that's going to both show up in terms of new products being possible and new businesses, and very significant improvements to the current business too.
Your next question comes from the line of Mark Mahaney with Evercore ISI. Please go ahead.
Thanks. Can I just ask just a question on Meta AI and both the product and a monetization path? So when you look at it, what you've seen that's most encouraging to you in terms of the adoption and the use of Meta AI, and then when you think about, I know you generally like to roll out and then deepen engagement and then later think about monetization. Like, where do you think you are on that path now? Is it clear to you what the monetization options are for Meta AI? Thank you very much.
I mean, I think the most promising thing that we're seeing is, one, that we were able to build something that a large number of people use, and I think that that's valuable. And then secondly, that there is a clear correlation as we improve the models in ways that we think make them better, that people use them more. So that shows that we have a runway to basically be able to improve engagement and turn this into a product that's leading over time. In terms of where we are on this, and we basically just did this huge effort to boot up Meta Superintelligence Labs and build what I am very proud of is, I think, the highest talent density lab in the industry at this point. There are a lot of really great researchers and infrastructure folks and data folks who are now a part of this effort, who are focused on training the next generation of work and doing some really novel work. And when that is ready, I think that we will be able to plug that into a number of the products that we're building, and I think that will be very exciting. But I think that that's really the next thing that we're looking at. And then from there, I think that these models will also improve monetization in all of the different ways that we've talked about so far, in terms of improving engagement, improving advertising, helping advertisers engage. I mean, there's the one opportunity that we usually talk about on these calls, but hasn't come up as much here, is just the ability to make it so that advertisers are increasingly just going to be able to give us a business objective and give us a credit card or bank account, and like have the AI system basically figure out everything else that's necessary, including generating video or different types of creative that might resonate with different people, that are personalized in different ways, finding who the right customers are. All of the capabilities that we're building, I think, go towards improving all of these different things. So I'm quite optimistic about that.
Your next question comes from the line of Ronald Josey with Citi. Please go ahead.
Great. Thanks for taking the question. And this maybe dovetails perfectly off of, Mark, what you just talked about. And, we heard a lot about end-to-end automation here, I think reaching a $60 billion ARR. I wanted to hear about, if you can talk to us more just about adoption rates amongst the advertisers, and then maybe bigger picture, as you incorporate ranking recommendation changes like Andromeda or GEMS or Lattice, just talk to us how this automation is driving, call it, a higher ROI for advertisers overall as we bring it all together. Thank you.
Yeah, so we've been sort of laying the continued brick by brick build of Advantage Plus and extending the set of objectives that it applies to over time. And so in Q3, we completed the global rollout of the streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers who are running sales app or lead campaigns have end-to-end automation turned on from the beginning. And like, the kind of application of the streamlined campaign creation flow for other objectives, this generally allows advertisers to optimize and automate several aspects of the campaign setup process at once. That includes things like audience selection, where to show the ad, how the budget gets paced and distributed across ad sets to drive the most efficient outcomes. And, we see that Advantage Plus continues to drive performance gains. Advertisers who run lead campaigns using Advantage Plus are seeing a 14% lower cost per lead on average than those who are not. And I would say that we think there is still a lot of opportunity generally to grow adoption of Advantage Plus. A lot of advertisers only use our end-to-end automated solutions for a portion of their campaigns, so we can grow share there. And to capture that opportunity, we're focused on driving continued performance improvements and addressing some of the key use cases that we still need in order to grow adoption. We're also working to broaden adoption among advertisers who use one of our single-step automated solutions. For example, advertisers who might only use a piece of it, like Advantage Plus Audiences, by helping them understand the benefits of using more than one automated solution at the same time. So I would say Advantage Plus is sort of an ongoing platform by which we both continue to expand the feature set that is available in Advantage Plus, and then expand the extensibility or the coverage of that feature set to sort of the broader set of advertisers. I think Mark mentioned that the annual revenue run right now for advertisers who are using these automated options is, $60 billion. And again, we see that there's room to continue growing that.
Your next question comes from the line of Youssef Squali with Truist Securities. Please go ahead.
Great. Thank you very much. Mark, on wearables in particular, do you think you'll be able to sell enough hardware to recoup your investment, or is that dependent on maybe creating new avenues for revenue from things like advertising services and commerce through that new computing platform? And if so, what are kind of the gating factors there? And then Susan, how do you see the on-balance sheet versus off-balance sheet financing of your AI initiatives? You've recently struck a deal with Blue Owl for the Louisiana data center. Is that part of the CapEx guide for 26? And if it's not, how significant will that way of funding be for Meta going forward? And basically, would that slow down your CapEx growth past 2026? Thank you.
I can talk about wearables, and then Susan can jump in on the other part. So I think that there are a few pieces here. One is that the work that on Ray-Ban Meta and the Oakley Meta products is going very well. I think, yeah, I mean, at some point, if these continue going as well as it has been, then I think it will be a very profitable investment. I think that there's some revenue that we get from basically selling the devices, and then some that will come from additional services and from the AI on top of it. So I think that there's a big opportunity. Certainly, the investment here is not just to kind of build just the device. It's also to build these services on top. Right now, a lot of people get the devices for a range of things that don't even include the AI, even though they like the AI. But I think over time, the AI is going to become the main thing that people are using them for. And I think that that's going to end up having a big business opportunity by itself. But, as products like the Ray-Ban Meta and Oakley Metas are growing, we're also going to keep on investing in things like the more full field of view product form of the Orion prototype that we showed at Connect last year. So those things are obviously earlier in their curve towards getting to being a sustaining business. And our general view is that we want to build these out to reach many hundreds of millions or billions of people. And that's the point at which we think that this is going to be just an extremely profitable business.
Youssef, to your second question, so the JV that we announced with Blue Owl is sort of an example of finding a solution that enabled us to partner with external capital providers to co-develop data centers in a way that gives us long-term optionality in supporting our future capacity needs, just given both the magnitude but also uncertainty of what the capacity outlook in future years looks like. In terms of how that is recognized as CapEx, our prior CapEx reflected a portion of the data center build cost prior to the joint venture being established. Going forward, the construction costs of the data center will not be recorded in CapEx as the data center is constructed. We will contribute 20% of the remaining construction costs required, which is in line with our ownership stake, and those will be recorded as other investing cash flows.
Your last question comes from the line of Ken Gawrelski with Wells Fargo. Please go ahead.
Thank you. Just one for me, please. Mark, as you think about with hopefully a leading frontier model next year in hand, could you talk about
where you think the value will accrue in this evolving ecosystem? Will it be with the platforms, or do you think that this will be mostly the value will accrue to the scaled first-party applications? Thank you.
I guess I'm not exactly sure what you mean by platform versus application in this context, but I mean, I think that I think that there's just a lot of value to create with AI overall. So I mean, clearly you're seeing the people who are making the hardware. I mean, NVIDIA is doing an amazing job, right? I think extremely well-deserved success. The cloud partners and companies are doing very well. I think that will likely continue. I think there's a huge opportunity there. And but if you look at it today, the companies that are building apps, I mean, a lot of the apps are still relatively small, and
Google's earnings call is starting right now, so we're gonna have to switch away from that and switch over to Google. Here we go. Can you guys hear anything, or are you guys messing with me? Are you guys messing with me? Can you hear anything or no? Paul, I'm going to trust you that you're telling the truth. Let me try that again.
Non-GAAP financial /investor.
Got it.
Our comments will be on year-over-year comparisons unless we state otherwise. And now I'll turn the call over to Sundar.
Thank you, Jim. Good afternoon, everyone, and thanks for joining us. This was a terrific quarter for Alphabet, driven by double-digit growth across every major part of our business. We are seeing AI now driving real business results across the company. We delivered our first ever $100 billion quarter. 5 years ago, our quarterly revenue was at $50 billion. Our revenue number has doubled since then, and we are firmly in the generative AI era. In parallel, we've built for the long term and diversified with successful businesses in cloud, YouTube, and subscriptions. Our momentum is strong, and we are shipping at speed. As just a few examples, our first-party models like Gemini now process 7 billion tokens per minute via direct API use by our customers. The Gemini app now has over 650 million monthly active users, and queries increased by 3x from Q2. Cloud had another great quarter of accelerating growth with AI revenue as a key driver. Cloud backlog grew 46% quarter over quarter to $155 billion. And we crossed 300 million paid subscriptions, led by growth in Google One and YouTube Premium. Today, I'll discuss progress in our full-stack approach to AI and then share highlights from Search, Cloud, YouTube, and Waymo. As a reminder, our full-stack approach spans AI infrastructure, world-class research, including models and tooling, and our products and platforms that bring AI to people everywhere. First up, AI infrastructure. Our extensive and reliable infrastructure, which powers all of Google's products, is the foundation of our stack and a key differentiator. We are scaling the most advanced chips in our data centers, including GPUs from our partner NVIDIA, as well as our own purpose-built TPUs. And we are the only company providing a wide range of both. As we announced yesterday at NVIDIA GTC, we are now shipping the new A4X Max instances powered by NVIDIA GB300 to our cloud customers. Our highly sought-after TPU portfolio is led by our 7th generation TPU Ironwood, which will be generally available soon. We are investing in TPU capacity to meet the tremendous demand we are seeing from customers and partners, and we are excited that Anthropic recently shared plans to access up to 1 million TPUs. Next, world-class AI research, including models and tooling. Our models are world-leading. Gemini 2.5 Pro, Veo, Genie 3, and our viral sensation Nano Banana are among the very best in class. Over 230 million videos have been generated with Veo 3, and more than 13 million developers have built with our generative models. We are looking forward to the release of Gemini 3 later this year. Our research leadership is advancing next frontier technologies. Last week, we announced that our Willow quantum chip achieved a major breakthrough, running an algorithm 13,000 times faster than one of the world's best supercomputers. And the result is verifiable, paving the way to future practical applications. Speaking of quantum, let me congratulate Michel Devray, our chief scientist for quantum hardware. He received a Nobel in physics for early research he did in the 1980s. 3 Nobels awarded to current Googlers in 2 years. Incredible. And third, our products and platforms. We are bringing AI to more people and developers than anyone else. In July, we announced that we processed 980 trillion monthly tokens across all our surfaces. We are now processing over 1.3 quadrillion monthly tokens, more than 20x growth in a year. Phenomenal. This quarter, we took big steps to reimagine Chrome as a browser powered by AI through deep integrations with Gemini and AI mode in search, with more agentic capabilities coming soon. In August, at Made by Google, we unveiled our Pixel 10 series of devices. They are the first with our most powerful chip designed to run on Gemini Tensor G5. They are our best reviewed devices ever. And last week, we launched Android XR, our new operating system with Samsung's Galaxy XR device. It brings new ways to use headsets and glasses with Gemini at the core. Now turning to highlights from search. AI is driving an expansionary moment for search. As people learn what they can do with our new AI experiences, they're increasingly coming back to search more. Search and its AI experiences are built to highlight the web, sending billions of clicks to sites every day. During the Q2 call, we shared that overall queries and commercial queries continue to grow year over year. This growth rate increased in Q3, largely driven by our AI investments in search, most notably AI overviews and AI mode. Let me dive into the momentum we are seeing. As we have shared before, AI overviews drive meaningful query growth. This effect was even stronger in Q3 as users continue to learn that Google can answer more of their questions. And it's particularly encouraging to see the effect was more pronounced with younger people. We're also seeing that AI mode is resonating well with users. In the US, we have seen strong and consistent week-over-week growth in usage since launch, and queries doubled over the quarter. Over the last quarter, we rolled out AI mode globally across 40 languages in record time. It now has over 75 million daily active users. And we shipped over 100 improvements to the product in Q3, an incredibly fast pace. Most importantly, AI mode is already driving incremental total query growth for search. Philip will talk more about monetization and share how AI is helping people connect with businesses and shop on search. Next, Google Cloud. Our complete enterprise AI product portfolio is accelerating growth in revenue, operating margins, and backlog. In Q3, customer demand strengthened in 3 ways. 1, we are signing new customers faster. The number of new GCP customers increased by nearly 34% year over year. 2, we are signing larger deals. We have signed more deals over $1 billion through Q3 this year than we did in the previous 2 years combined. Third, we are deepening our relationships. Over 70% of existing Google Cloud customers use our AI products, including Banco BV, Best Buy, and FairPrice Group. As we scale, we are diversifying revenue. Today, 13 product lines are each at an annual run rate over $1 billion. And we are improving operating margin with highly differentiated products built with our own technology. This deep product differentiation starts with our AI infrastructure. We have a decade of experience building AI accelerators and today offer the widest array of chips. This leadership is winning customers like HCA Healthcare, LG AI Research, and Macquarie Bank. And it's why 9 of the top 10 AI labs choose Google Cloud. We are also the only cloud provider offering our own leading generative AI models, including Gemini, Imagen, Veo, Chirp, and Lyria. Adoption is rapidly accelerating. In Q3, revenue from products built on our generative AI models grew more than 200% year over year. Over the past 12 months, nearly 150 Google Cloud customers each processed approximately 1 trillion tokens with our models for a wide range of applications. For example, WPP is creating campaigns with up to 70% efficiency gains. Swarovski has increased email open rates by 17% and accelerated campaign localization by 10 times. Earlier this month, we launched Gemini Enterprise, the new front door for AI in the workplace, and we are seeing strong adoption for agents built on this platform. Our packaged enterprise agents in Gemini Enterprise are optimized for a variety of domains, are highly differentiated, and offer significant out-of-box value to customers. We have already crossed 2 million subscribers across 700 companies. Next, YouTube. In the living room, YouTube has remained number 1 in streaming watch time in the US for more than 2 years, according to Nielsen. Last month marked YouTube's first time as a live NFL broadcaster. This exclusive global broadcast, live from Brazil, drew more than 19 million fans and set a new record for most concurrent viewers of a live stream on YouTube. YouTube Shorts also continues to perform well. In the US, Shorts now earn more revenue per watch hour than traditional in-stream on YouTube. At our Made on YouTube event, we rolled out a number of AI-powered features that are helping creators supercharge creation and build their businesses. AI is now streamlining the entire content creation workflow, from generative video tools and more efficient editing to AI-powered insights that help creators optimize their channels. We are also using AI to expand monetization, automatically identifying products to make their videos more shoppable. Philip will discuss in more detail. And finally, Waymo. Next year, Waymo aims to open service in London, and they are working to bring service to Tokyo. They've also announced expansions to Dallas, Nashville, Denver, and Seattle, and secured permission to operate fully autonomously at San Jose and San Francisco airports. Autonomous testing continues to scale in New York City. The new Waymo for Business allows enterprises to offer Waymo as a work travel option. And we launched Waymo Teens accounts in Phoenix this summer. We are pleased to see usage steadily increase with positive feedback from teens and their parents alike. Waymo's growth and momentum are strong, and 2026 is shaping up to be an exciting year. Overall, a milestone quarter. The incredible work of our teams is driving momentum across the board, and our leadership in AI positions us so well for the opportunity ahead. I want to thank all of our partners and our employees for their hard work and an excellent Q3. With that, I'll turn it over to Philip.
Thanks, Sundar, and hello, everyone. I'll quickly cover performance for Google Services for the quarter, then structure the rest of my remarks around the great progress we're delivering across Search, Ads, YouTube, and partnerships. Google Services revenues were $87 billion for the quarter, up 14% year-on-year, driven by accelerated growth in Search and YouTube, partially offset by year-on-year decline in network revenues. Adding some further color to our results. The 15% increase in Search and Other was led by growth across all major verticals, with the largest contributions from retail and financial services. YouTube saw similar performance across verticals. Its 15% growth in advertising revenues was driven by direct response, followed by brand. Starting with Search and Other revenues, which delivered over $56 billion in revenue for the quarter. As Sundar mentioned, AI is driving an expansionary moment and transforming how people use Google Search. Our investments in new AI experiences, such as AI overviews and AI mode, continue to drive growth in overall queries, including commercial queries, creating more opportunities for monetization. These AI experiences are enhancing how people connect with businesses and shop on search. We recently added shopping capabilities in AI mode, which now help people shop conversationally in search, and we expanded try-on capabilities to more clothing items, now available to anyone in the US. Lastly, we're making it easier for consumers to benefit from deals through new loyalty offerings like personalized annotations on organic results and ads. Looking at monetization, businesses can now tap into our most powerful AI search experiences. Using our most advanced AI models, we can understand and predict intent like never before, unlocking entirely new commercial pathways to provide valuable new consumer connections and helping us monetize even more efficiently. Rolled out globally in September, AI Max and Search is already used by hundreds of thousands of advertisers, currently making it the fastest growing AI-powered search ads product. In Q3 alone, AI Max unlocked billions of net new queries. By delivering the most relevant ad across surfaces and matching advertisers against additional queries they weren't reaching before, AI Max helps advertisers discover new customers at the exact moment they need their product or service. Kayak, for example, looked to grow conversions while staying within their ROAS goals. After turning on AI Max and Search, they grew the conversion value by 12% in early tests. We continue to infuse generative AI capabilities at every step of the marketing process. We rolled out Imagen 4 in Asset Studio and Product Studio, helping businesses produce more and better creatives. On the measurement front, we enriched the model supporting Meridian, our marketing mix model, with additional variables. And more granular reporting in PMax is making bidding more effective. Financial services company SoFi has been using PMax to meet its ambitious growth targets and help drive a 39% improvement in its conversion volume year over year. Moving to YouTube, where we saw accelerated revenue growth, our recommendation systems are driving robust watch time growth in our key monetization areas like Shorts and Living Room. As we leverage Gemini models, we're seeing further discovery improvement. On direct response, we're excited about the growth in revenue we're seeing, especially from small and medium advertisers adopting Demand Gen. We also improved performance on Demand Gen, with over 100 launches helping to increase conversion value by more than 40% for advertisers using target-based bidding on YouTube. The retail vertical continues to lead our growth on YouTube, with Demand Gen helping us further monetize shopping-related categories. Looking at the living room, our long-term bet, more advertisers are adopting interactive direct response ads, leading to an annual revenue run rate exceeding $1 billion globally for this format. For our viewers, we continue to give fans greater access across sports while tapping into the best of YouTube's product innovation and creator-led content. Sundar mentioned that we expanded our NFL partnership with our first ever exclusive global broadcast of an NFL game. Brands loved the opportunity, and we sold all our ad inventory within a couple of weeks. Looking at creators, a significant force behind the thriving YouTube creator economy is the collaboration between creators and brands. Tools like direct linking to deals, websites, and Shorts and swappable brand segments in long form will soon help creators show how they deliver great value for brands. Thanks to a collaboration with Dude Perfect, Comcast Xfinity drove an 8% search lift, beating other Xfinity ads' recall lift on Shorts by 34%. At the same time, it decreased the cost per lifted user by 50% when compared to the next most efficient ad. We continue to invest in AI-powered features that are helping creators supercharge creation and build their businesses. With VO3 integration and speech-to-song, creators go from idea to iteration quicker, and new channel insights help them better understand performance. Ending on YouTube with our subscriptions products, we're also seeing momentum with strong growth in offerings such as YouTube Music and Premium and YouTube TV. We're also applying Gemini internally to help us serve customers with increased speed, intelligence, and efficiency. Our sales teams use Gemini enriched with ads knowledge to streamline customer interactions. This increased productivity by over 10%, led to hundreds of millions in incremental revenue, and frees up sellers to engage with more customers at a deeper, more strategic level. In our customer support division, Gemini-powered solutions have managed over 40 million customer sessions so far this year and resolved hundreds of thousands of customer inquiries, and we're just getting started. As always, I'll wrap with the progress we're seeing across partnerships where our customers tap into the strength and breadth of Google's products to accelerate their transformation. Revolut, the global financial services company, leverages Google Cloud's Vertex AI platform and Gemini models to help power its advanced customer service chatbot, develop new hyper-personalized financial products, and offer predictive insights. Revolut is also increasing its presence on YouTube, adopting VO3 for personalized creatives, making Google a key ads partner for delivering growth and launching new markets. In closing, I'd like to thank Googlers everywhere for their contributions to our success, and as always, to our customers and partners for their continued trust. And, of course, a huge thanks to all of you as we celebrate 25 years of Google Ads. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the third quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment results. I'll end with some commentary on our outlook for the fourth quarter of 2025. We had an outstanding quarter in Q3, continuing the strong momentum we've had throughout the year, delivering double-digit revenue growth across search and YouTube advertising, subscriptions, platforms and devices, and Google Cloud. Consolidated revenue reached $102.3 billion, a 16% year-over-year increase, or 15% in constant currency. Total cost of revenue was $41.4 billion, up 13%. Tech was $14.9 billion, up 8%. Other cost of revenues was $26.5 billion, up 16%, with the increase primarily driven by content acquisition cost, largely for YouTube, followed by depreciation and other technical infrastructure operations cost. Total operating expenses increased 28% to $29.7 billion. R&D expenses increased by 22%, driven by compensation and depreciation expenses related to our AI efforts. Sales and marketing expenses were flat, and G&A expenses increased meaningfully, primarily due to the $3.5 billion charge related to the European Commission fine mentioned in the earnings press release. Operating income increased 9% this quarter to $31.2 billion, and operating margin was 30.5%. Excluding the EC fine, operating income increased 22%, and operating margin was 33.9%. Operating margin benefited from strong revenue growth and continued efficiencies in our expense base, offset by the legal charge and a significant increase in depreciation expense. Other income and expenses was $12.8 billion, primarily due to unrealized gains in our non-marketable equity securities portfolio. Net income increased 33% to $35 billion, and earnings per share increased 35% to $2.87. We generate free cash flow of $24.5 billion in the third quarter and $73.6 billion for the trailing 12 months. Free cash flow in Q3 benefited from strong operating cash flow and recent tax changes regarding the timing of when research and development costs are expensed and assets are depreciated. This was partially offset by higher CapEx. We ended the quarter with $98.5 billion in cash and marketable securities. Turning to segment results, Google Services revenues increased 14% to $87.1 billion, reflecting strength in Google Search, YouTube advertising, and subscriptions. Google Search and other advertising revenues increased by 15% to $56.6 billion, representing another robust quarter with continued growth across all major verticals, with the largest contributions from retail and financial services. YouTube advertising revenues increased 15% to $10.3 billion, driven by direct response advertising, followed by brand. Network advertising revenues of $7.4 billion were down 3%. Subscriptions, platforms, and devices revenues increased 21% this quarter to $12.9 billion, driven by very strong growth in both YouTube and Google One subscriptions. Google Services operating income increased 9% to $33.5 billion. Operating margin declined year-over-year to 38.5%, as healthy revenue growth and continued efficiencies in our expense base were offset by the impact of the EC fine, which was fully reflected in the Google Services segment. Turning to the Google Cloud segment, which again delivered very strong results this quarter as Cloud continued to benefit from our enterprise AI-optimized stack, including our own custom TPUs and our industry-leading AI models. Cloud revenue increased by 34% to $15.2 billion in the third quarter, driven by strong performance in GCP, which continued to grow at a rate that was much higher than Cloud's overall revenue growth rate. GCP's growth was driven by enterprise AI products, which are generating billions in quarterly revenue. We had strong growth in enterprise AI infrastructure and enterprise AI solutions, which benefited from demand for our industry-leading models, including Gemini 2.5. Core GCP was also a meaningful contributor to growth. And we had double-digit growth in Workspace, which was driven by an increase in average revenues per seat and the number of seats. Cloud operating income increased by 85% to $3.6 billion, and operating margin increased from 17.1% in the third quarter last year to 23.7% this quarter. The expansion in Cloud operating margin was driven by strong revenue performance and continued efficiencies in our expense base, partially offset by higher technical infrastructure usage cost, which includes depreciation expense and other operations costs such as energy. Google Cloud's backlog increased 46% sequentially and 82% year over year, reaching $155 billion at the end of the third quarter. The increase was driven primarily by strong demand for enterprise AI. As Sundar mentioned earlier, Cloud has signed more billion-dollar deals in the first 9 months of 2025 than in the past 2 years combined. In other bets, revenues were $344 million, and operating loss was $1.4 billion in the third quarter. Within other bets, we continue to allocate more resources to businesses like Waymo, where we see opportunities to create substantial value. With respect to CapEx, in the third quarter, our CapEx was $24 billion. The vast majority of our CapEx was invested in technical infrastructure, with approximately 60% of that investment in servers and 40% in data centers and networking equipment. In Q3, we returned capital to shareholders through repurchases of stock of $11.5 billion and dividend payments of $2.5 billion. Turning to our outlook, I would like to provide some commentary on factors that will impact our business performance in the fourth quarter of 2025, as well as an updated outlook for CapEx for the year. First, in terms of revenues, we're pleased with the overall momentum of our business. At the current spot rates, we could see an FX tailwind to our revenues in Q4. However, the volatility in exchange rates could affect the impact of FX on Q4 revenues. As for our segments, in Google Services, year-over-year comparisons in advertising will be negatively impacted by the strong spend on U.S. elections in the fourth quarter of 2024, particularly on YouTube. In Cloud, demand for our products remains high, as evidenced by the accelerating revenue growth and the $49 billion sequential increase in Cloud backlog in Q3. In GCP, we see strong demand for enterprise AI infrastructure, including TPUs and GPUs, enterprise AI solutions driven by demand for Gemini 2.5 and our other AI models, and core GCP infrastructure and other services, such as cybersecurity and data analytics. As I've mentioned on previous earnings calls, while we have been working hard to increase capacity and have improved the pace of server deployments and data center construction, we still expect to remain in a tight demand-supply environment in Q4 and 2026. Moving to investments, we're continuing to invest aggressively due to the demand we're experiencing from Cloud customers, as well as the growth opportunities we see across the company. We now expect CapEx to be in the range of $91 billion to $93 billion in 2025, up from our previous estimate of $85 billion. Keeping in mind that the timing of cash payments can cause variability in the reported CapEx number. Looking out to 2026, we expect a significant increase in CapEx and will provide more detail on our fourth quarter earnings call. In terms of expenses, first, as I've mentioned on previous earnings calls, the significant increase in our investments in technical infrastructure, will continue to put pressure on the P&L in the form of higher depreciation expenses and related data center operations costs, such as energy. In the third quarter, depreciation increased $1.6 billion year over year to $5.6 billion, reflecting a growth rate of 41%. Given the overall increase in CapEx investments, we expect the growth rate in depreciation to accelerate slightly in Q4. Second, we expect sales and marketing expenses to be more heavily weighted to the end of the year, in part to support product launches and the holiday season. Q3 was a strong quarter, and we're excited with the adoption of our AI products, helped by a rapid pace of innovation and great execution by our teams. This translated into strong momentum in search, YouTube ads, subscription platforms and devices, and cloud, resulting in our first $100 billion plus quarter. Now, Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press star one on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. Our first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Great. Thanks for taking my questions, everyone. The first one, maybe for Philip or Sundar, it's on agentic e-commerce and agentic travel. There's a lot of external Wall Street discussion about agentic e-commerce potentially monetizing at a lower rate than search. So the question is, what factors are you most focused on to sort of ensure a smooth transition for your search business and for your advertisers as you move over to a more agentic world? And the second one, Sundar, is on Waymo. How far are we from an integration of Waymo into more of the core Gemini capabilities and the users in the platform? You're taking your user data of where I'm going, what hotel I'm staying at, what airport I'm staying at, and have me integrate that into Waymo. So you can actually have users use their profiles to pre-schedule Waymos. How far off is that? What do we have to do?
Look, Brian, great question. This is all early, but we see agentic experiences really as additive to the way people seek information. It helps us answer people's tough questions. It helps people get stuff done, and it helps businesses in the process. And we're working on multiple agentic experiences across key verticals such as travel, commerce, shopping, and so on. And we're paying a lot of attention to creating a seamless user experience, but also to the fact that we need to integrate different partner ecosystems in a way that it creates value for them. And by the way, we're also working closely with a lot of our partners on the other side through our cloud services to improve their own agentic experiences. And so maybe we go a little deeper on the shopping side, where we actually use AI already very actively to improve the shopping experience. As you know, we launched a more visual experience on AI Mode, and that gives people a much more intuitive conversational way to shop. You can simply describe what you're looking for now, like the way you would talk to a friend, and we'll show you the visual shopping results. And then we think about building an agentic shopping future, and it has to be one, again, that benefits both users and merchants here. And you know that at AIO, we also introduced new agentic checkout, which will let shoppers use like agentic AI to buy products from merchant sites and so on. We have a partnership with PayPal to help merchants build agentic commerce experiences. We have a new open protocols for agent-to-agent transactions, and so on and so on.
And Brian, on Waymo, great question. I was reflecting, I think, on the exact same topic. I'm scheduled to meet with the team to do a review on it in a few weeks out. Look, it is an exciting time. Waymo clearly, is scaling up, particularly in 2026. And I think the possibility, as you said, of Gemini, particularly with the multimodal experience, as well as services like YouTube, I think there's a real opportunity to make the in-car experience dramatically better. Definitely something we are excited about, and you'll see newer experiences in 2026 for sure.
Great. Thank you both.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. Philip, maybe you can just talk more about some of the drivers of the core search strength. And I guess in particular, when you think about AI overviews and AI mode, we know that query growth is accelerating, but can you help us understand from there kind of what happens in terms of clicks per query and conversion conversion rates and pricing in these AI-driven search formats? And then, Anat, can you talk about where you see opportunities in the core cost base as you look to make room to absorb the rapid growth in infrastructure and depreciation going forward? Thanks.
So let me give you a bit of vertical color first. In Q3, search and other revenues, again, delivered growth across all major vertical, as we said. It was from retail and financial services. Healthcare was also a contributor to the growth here. Our new AI experiences, you mentioned them, AI overviews, AI mode, continue to drive growth in overall queries, including commercial queries, really creating more opportunities for monetization. AI overviews are scaling up and are working for our entire user base. We're now scaled to over 2 billion users here, and we're continuing to expand ads in AI overviews in English to more countries across desktop, mobile, and so on. And as I've shared before, for AI overviews, even at our current baseline of ads, below and within the AI's response, overall, we see the monetization at approximately the same rate. So over time, we're excited about the opportunity of richer experiences in AI mode and AI overviews to basically open up then the opportunity for also much richer placements. I think, as I've said on a prior call, we managed a business to drive great outcomes for our users and an attractive ROI for our advertisers. We don't really manage to paid clicks and CPC targets. But as you will see in the 10Q, paid clicks were up 7% year on year, and CPCs were up 7% year on year.
Doug, and to your question around where else can we see more opportunity for efficiency and productivity, and I think you heard me say before, this is not a one-time type of effort, but rather an ongoing way in which we manage the business. And the key here is that the more we drive productivity across our business, the more we can invest in the business for growth and obviously continue to drive improvement in the P&L. Some of the areas are things that you've heard us talk about in the past, such as moderating the pace of headcount growth, optimizing our real estate footprint, but also as we invest more and more in our technical infrastructure, ensuring that we are optimizing that build out and the overall technical infrastructure we have. You know that a lot of the data centers, for example, that we build ourselves, so they're optimized and we make sure we do them in the most efficient way. Sundar mentioned on one of the previous calls the productivity associated with leveraging AI for Google. So it is the example, the percent of code, now nearly half of all code generated by AI. That's a way for us to leverage AI to drive further productivity across the business. And obviously, we always look at making sure that when we provide services or products, that we get the right economics and the right value for what we provide. So one good example is Shorts, which has a lower revenue share than InStream, that it helps to improve some of our gross margins. So this is an effort we have ongoing. I've mentioned in the past that we have a headwind with depreciation, obviously increasing alongside our CapEx increase. So we have efforts across the organization to ensure we run the business in the most disciplined and productive way while continuing to invest for future growth.
Thank you both.
Our next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thank you so much for taking the questions. Maybe two, if I could. Sundar, when you think about your custom silicon efforts across the organization, can you reflect a little bit about the opportunity set you see with each passing generation of custom silicon, both in terms of driving operating efficiencies inside the organization and potentially increased monetization efforts around those outside of the organization? Second question would be for Philip. Obviously, we can see the YouTube advertising revenue number in the reported results. Can you reflect a little bit about the scaling of the subscription side of YouTube offerings and how the two parts in together maybe represent an interesting framework in thinking about the monetization side of YouTube increasingly being a mix of both ads and subscription? Thank you.
Eric, overall, I would say we are seeing substantial demand for our AI infrastructure products, including TPU-based and GPU-based solutions. It is one of the key drivers of our growth over the past year, and I think on a going forward basis. I think we continue to see very strong demand, and we are investing to meet that. I do think a big part of what differentiates Google Cloud, effectively, we've taken a deep full stack approach to AI. So we are, and that really plays out, right? We are the only hyperscaler who's really building offerings on our own models. And we are also highly differentiated on our own technology. So to your question, I think that does, give us the opportunity to continue driving growth and operating margins in cloud as we have done in the past. And also, I think from a revenue, sets the infrastructure portion of our business to be a growth driver looking ahead as well.
And to the second part of your question, look, just taking a quick step back, we often describe YouTube's business as a flywheel. Obviously, it first all starts with the creators, and we have significantly invested here to be the place that YouTube creators really call their home. That's a big piece of it, the number one piece. Viewers, of course, YouTube has billions of monthly logged-in users, and every day people watch billions of hours of video. And we talked about how our recommendation systems are driving robust watch time growth, and so on and so on. So on the monetization side, YouTube's business is really powered, I would say, let's call it a twin engine monetization strategy, combining its advertising business and its growing subscription services. Both YouTube ads and subscriptions saw strong growth this quarter. And so looking at YouTube Music and Premium, users are on average delivering more value to creators, to music media partners, and YouTube itself than even ad-supported users do. So in other words, on average, a YouTube Music and Premium subscriber generates a meaningful higher gross profit than they were simply an ad-supported users. And fans come from all over the world, this, and this engagement through ads and subscription generates YouTube's revenues and funds what I started with, these creators here. And this then drives more viewership and engagement and so on. And that's the flywheel. And so our priority continues like this growth cycle. We're happy with this twin engine monetization strategy.
Our next question comes from Mark Shmulik with Bernstein. Your line is now open.
Yes, thanks for taking the questions. Sundar, with the strong adoption of Gemini, AI mode, and overviews across the user base, are there any meaningful differences to call out kind of around the behavior and depth of engagement for those users across the entire Google ecosystem? And then, Philip, I know we kind of asked this, most quarters, but I'm curious kind of with some of the adoption you've seen around AI overviews and mode, how you see the economics of search evolving with the higher commercial and total query volume, and how it kind of compares against the incremental cost to deliver these results. Thank you.
Mark, look, I think obviously AI overviews are a natural part of the Google experience. And so, engagement is very, very high. I would say AI mode, you have a varied cohorts. There are people who are casual users who are checking it out, but there's a core group which really likes AI mode and is passionate about it. And so you see the early adopters, the product is resonating very strongly, and they are seeking it out. So I think that's how I would highlight the difference. With Gemini, again, set of engaged user base who are seeking out the product and so on. But across the board, I think the trajectory has been. We are definitely seeing in each of those use cases a set of early adopters, and then more people coming in, and the people who are using it continue to use it more over time and report high user satisfaction. So I would say the underlying product metrics are pretty encouraging to see as well.
Look into the second part of your question. I think we covered before, Sundar covered the query development. And as I've just said before, for the AI overviews, even at our current baseline of ads, right, whether above, below, and within the AI response, overall, we see the monetization at approximately the same rate. And this is a great baseline for further innovation. We talked about this. We're excited about where this can go. And on the AI mode side, we're testing ads in AI mode, and we'll continue to test and learn before we expand this any further. So this in combination with what we mentioned about the commercial query overall development, I think we're in a good place here. You could also argue that on queries that historically have not been well monetized, we think there's a potential opportunity here where you can obviously imagine that we can build this out with smart AI integration.
Our next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. I have two, one for Philip, one for Anat. Philip, it's clear that when people use AI mode, the query length is much longer. Can you talk about how that longer length may be impacting your ability to drive ROAS and what you're seeing in terms of some of the benefits of maybe longer query length? And then, Anat, you came to Alphabet from a pharmaceutical company. You've been there more than a year. Can you talk a bit about how you're working to look at ROIC internally, and what early signs are you seeing that gives you confidence that this spending is really driving better returns longer term? Thanks.
Look, as Sundar shared, AI Mode now has over 75 million daily active users in the US, and we see strong and consistent week-over-week growth in usage since launch, and the queries doubled over the quarter. And as I also mentioned, we're testing ads in AI Mode. We'll continue to test before we expand any further. It's really too early to tell and go into any of the details of that testing.
Okay.
Yes, and the question related to ROIC and how we look at just overall our business and where do we see early signs that are encouraging. So first, I would say it's not just early signs because we're seeing returns, obviously, in the cloud business. You've heard us talk about the fact that we already are generating billions of dollars from AI in the quarter. But then across the board, we have a rigorous framework and approach by which we evaluate these long-term investments that are meant to do two things. One is to ensure we build a resilient growth profile for the company, but also that we meet the demand of the customers that we have here in the more near and midterm. So we look at it across the business. We evaluate the potential return for each one of them, whether it's in cloud, and I think that's more visible, obviously, externally, given that you see the revenue generated and the fact that we're unable to meet at this point customer demand. We have more demand than we have supplied. In our ads business, you see the fact that we're investing to transform search, as you heard from Philip and Sundar with AIO and AI Mode. So we're excited to see what our investments are, how the investors are helping advertisers as well. YouTube, where it's helping power recommendations. So when we make a decision on investment in the long term, we go through a very rigorous process of assessing what the return could be and over what time frame we will see that return to give us the high level of confidence to then invest and make those investments for the long term. So it's a very rigorous approach.
Thanks.
Our next question comes from Ross Sandler with Barclays. Your line is now open.
Great. About 20% of Google's search queries are commercial historically, and you've talked a bunch on this call about how AI overviews are kind of expanding the breadth of queries. Could you talk about how new products on the monetization side, like AI Max, are potentially increasing the percent of commercial queries?
So, look, AI Max, and I mentioned this in my call before, improves the ability for advertisers to target a wider range of queries. Separately, there is the question of whether queries actually increase with AI Mode, and Sundar actually talked about it and mentioned the opportunity that he sees here. So I think it's important to separate those two things. And I personally also see, this is what I just said in my last remark, that I think over time there's an opportunity to actually take, let's say, queries that are not fully commercial, but could have an adjacent commercial relationship to basically expand this into more attractive ads offerings while really creating a really interesting user experience at the same time.
Yeah, and the only thing I would add is just stepping back broadly, I think AI overviews and AI Mode are, dramatically improving search. We can see it in user satisfaction, user quality, all our metrics. And they're universal in the nature. They apply across the universality of human needs. So I think we are seeing it in breadth. And so, naturally over time, that'll apply to commercial categories as well.
Our next question comes from Ken Gawrelski with Wells Fargo. Your line is now open.
Thank you very much. Two questions, please. First, it appears more and more clear that all the new modes, whether at Google with Gemini overview, AI overviews, AI mode, even ChatGPT, is growing the addressable market for engagement in search-like behavior. Could you talk about what gives you confidence that it will also grow the addressable market for marketing activity and overall revenue associated with that behavior? That's question one. And question two is just more about, as you think about AI mode, AI overviews, and traditional Google search, how do you think, do you see a world in 12 to 24 months, those all coexist? And does the user eventually pick what mode they want? Does the algorithm pick the mode? Can you talk a little bit about how you think that will progress over the next 12 to 24 months? Thank you very much.
Ken, thanks. Look, I think it's a dynamic moment, and I think we are meeting people in the moment with what they are trying to do. Obviously, search is evolving, and between AI overviews and AI mode, I think we are able to kind of give that range of experience for people in this moment. Over time, you can expect us to make the experiences simpler in a way that, just like we did universal search many, many years ago, we may have done text search, image search, video search, etc., and then we kind of brought it together as universal search. So you will see evolutions like that, but I think we want to be sensitive to making sure we are meeting the users, in terms of what they are looking for. I think Gemini allows us to build a more personal, proactive, powerful AI assistant for that moment, and I think having the two surfaces, Search and Gemini, allows us to really serve users across the breadth of their needs. But over time, we will thoughtfully look for opportunities to make the experience better for users. And to the first part, I would broadly say, I do think we've been consistently saying for a while now, this is an expansionary moment, and we are seeing people engage more. And I think when they do that, naturally a portion of that information for users, those journeys are commercial in nature. So I would expect that to play out over time as well.
Our last question comes from Justin Post with BAML. Your line is now open.
Great. Just a couple. Sundar, I think you mentioned Gemini 3 is coming. Maybe you comment on the pace of innovation in frontier models. Is there still just a tremendous amount of innovation, or is it slowing at all? And then you mentioned, a number of large deals signed in the last 9 months for cloud, which is great. Any changes in the economics of these deals as far as long-term profitability? Anything we should be aware of? Thank you.
Thanks, Justin. The first on the pace of frontier model research and development. Look, I think two things are both simultaneously true. I'm incredibly impressed by the pace at which the teams are executing and the pace at which we are improving these models. But it also is true at the same time that each of the prior model you're trying to get better over is now getting more and more capable. So I think both the pace is increasing, but sometimes we are taking the time to put out a notably improved model. So I think that may take slightly longer, but I do think the underlying pace is phenomenal to see, and I'm excited about our Gemini 3.0 release later this year. On cloud, I would point out, as a sign of the momentum, I think the number of deals greater than $1 billion that we signed, in the first 3 quarters of this year are greater than the 2 years prior. So we are definitely seeing strong momentum, and we are executing at pace. And in terms of long-term economics, I would say that, again, us being a full stack AI player And the fact that we are developing highly differentiated products on our own technology, I think will help us, drive a good trajectory here, as you have seen over the past few years.
Great, thank you.
Thank you, and that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Thanks, everyone, for joining us today. We look forward to speaking with you again on our fourth quarter 2025 call. Thank you, and have a good evening.
Okay. Yeah, I mean, where do we even freaking begin? This was a bullish day all around. CapEx spend, artificial intelligence, the train continues to go forward. I mean, we're going ahead. Waymo looks really good. YouTube growth in ads and subscriptions. AI mode and overviews are looking at the same monetization rate as Google search generally. So all of that's looking really good. GCP growth, they signed more billion-dollar deals in the first 9 months than the last 2 years combined. Backlog grew by 46% quarter over quarter. Yeah. YouTube remains the number one US streaming watch time for over 2 years now. Shorts can now earn more revenue per watch hour than an in-stream video. Just crazy. Crazy. Already 2 million subscribers across 700 companies are now using Gemini enterprise agents. The stock is up 6.5% on the day. Or sorry, not on the day, in after hours. That's on top of a 2.65% increase on the day. Microsoft ended up falling 3.5%. You know what I think this was on? On the news of this right here. I think this was comments that said the combination of OpenAI's conversion to a public benefit corporation and the ongoing nature of our partnership will result in increased volatility. Therefore, going forward, we will provide our outlook excluding any impact from our investments in OpenAI on that basis in Q2. We will provide our outlook excluding any impact from our investments in OpenAI. People don't like uncertainty. Huge red candles. Then a little bit of recovery afterwards. So Microsoft being essentially flat on the day, down 3.5% in the after hours. Meta flat on the day, down 7.7%. I bought a little bit of Meta in after hour markets. We'll see what ends up happening. What did you guys think? This is why humanity's getting laid off. I don't actually think we're seeing that. I think there's signs that everyone wants to point to. There were signs last year that everyone pointed to. Oh, AI is taking jobs in 2024. I think some of those concerns are overblown so far. We'll see. I mean, I'm still going to monitor it. I'm not brushing it off, but I think right now it's too early to tell. All right. I've got another show at 8:30. This is where I'm going to be breaking down some of the other news that ended up happening, not just big tech earnings, and talk about some actual trades and investments that we've been making, and stuff like this. We do a daily recap every single day. So if you guys like that sort of content, usually it's at 7 p.m. This time it's at 8:30 p.m. Eastern Standard Time. If you guys like that, hit the subscribe button down below. But until next time, bye for now.